Hello everybody, my name is Mark. Welcome to another video. And in this video, I am going to explain what is an option butterfly, and the stock of the day is Uber. And I put on an option butterfly. It's very convoluted, but I will explain the option butterfly very simply here in a minute. So this is what I did on Uber. I bought a put, I sold a put, and then I sold 8 puts, and then I bought 1 put. And I bought a $40 put, sold a $35 put, and then I sold 8 $35 puts, and I bought 8 $25 puts. So in a very roundabout, convoluted way, this is an option butterfly. Now, Uber is the stock of the day, and we just had an election, and Proposition 22 passed in the state of California, which allows Uber drivers to remain as independent contractors. If Prop 22 fails, then Uber drivers are forced to become classified as employees, and instead of what you see Uber did here, you would have seen Uber go down this way. And I would have been doing something very differently had that would have happened. But because Uber went this way, I do think it is overbought, and that's why I chose to do the butterfly instead of just going straight up long. The premiums were not very good at these levels a month out. I think it's only like a 0.5%. And so I wanted to do the butterfly, but I wanted to give myself a lot of premium, which is why I did the big, long, convoluted thing that you see right here. So let me start out by just explaining a simple option butterfly. And if you want, this is what I'm doing. If you want to be specific, it's a long butterfly spread with puts. If you'd rather, you can read through this read through this article at your own leisure. But let me explain in the video what is an option butterfly. So let's go to the Uber stock and let's pull up an option chain. And I think when you get done watching this, you'll have a very good understanding. So, and by the way, the long put that I bought was 224 days out. So let's go ahead and do this. And let me go to out of the money like this. And here it is right here. So let's say that you were to buy a $40 put option, and let's say you get it filled at 430, and then let's say you sell a $35 put option, and let's say you get the order filled at 240. So that would be, actually, let's round it down just so to make the math easy. Let's say 230. So 430 minus 230, you would take a debit of $200. Now, this is in 6 months. So let's say in 6 months, Uber drops all the way to $30. How much money would you make? Well, your $40 put would be worth 30, so it would be worth $1,000. Okay, your short put that you got $230 would be worth $5. Now, if it went just to $35, then you took in a debit of 430 minus 230, which is 200. So you would make a $300 profit. Hopefully you can see that, right? Because your $40 put would be, if Uber went to 35, would be worth $500. But you spent 430 for that. If you just bought the $40 put by itself and you didn't even sell a put, you would make $70. So actually, selling the put would increase your profit if the Uber went from 40 to 35, because you're now taking in this credit of 230. Even though, just for the simpleness of the video, yeah, you'd actually get more, you'd make a little more, but for the simpleness of the video, I'm saying the order gets filled at 230. So you're taking in a debit of $200. You're spending $200 to own a $40 put. And if Uber went to 35, then your $200 that you spent would be worth $500, giving you a total of a $300 net profit. Now, every dollar that Uber drops below that, if it went to 34, it's a wash, because even though your long put, your $40 put is now worth $600, you shorted the $35 put, and that's worth $1. And because you sold to open it, then you would take a loss on that, but you'd take a gain, and so they cancel each other out cancel each other out. Much like a covered call, your profits would be capped. Now, butterfly. Okay, what is a butterfly? A butterfly is you would, for example, buy the $40 put, you'd sell a $35 put, and then you'd sell another $35 put, and then you might buy the $30 put. Okay, now this changes the scenario. Now you know that if you were to just sell a $35 put and buy a $30 put, that is known as a credit spread. That is a bull put spread. And ideally, you would want Uber to trade above $35 a share. If it started to go down, you'd begin to lose money. But look at what happens because you're doing both this debit spread and you're doing this credit spread. You now have four options. You have a long put here, a $40 put. You have a long put down here, a $30 put, and you're selling two puts, two $35 puts. And so your max profit, best case scenario, is for Uber to go to 35. You wouldn't want it to go to 34 or 33. That would cut into your profit, right? But if it went to 35, you would make that $300, but you'd also make extra money because you're doing a credit put spread. So this, and again, you can read all this on your own. This is a long butterfly spread with puts. And so the basic idea of a butterfly, an option butterfly, is you are basically buying two puts or more, and you are selling the same number of puts. And you have the outside, which is the upper limit and the lower limit, the 40 and the 30. And then you have the middle part, which is 35. Okay, so try not to get too hung up on the terminology and the memorization as long as you understand the basic premise. Now, suppose that you believe Uber, and just FYI, I believe Uber is overbought. Okay, now you could go long on Uber if you think Uber is just going to keep going up, up, and up. I don't believe that. I think there is going to be a pullback, and so that's why I went with the put butterfly spread. Okay, so that's the reason why. And let me go to my positions so you can visualize better what I did. So here's my positions right here. And down here you can see all my Uber. So there's my $40 put. And there's my $35 put right there. And then there's 8 puts. So this is very convoluted. If I was just do a straight up option butterfly, then I would have bought the 40 put, sold the 35 put, and then sold another 35 put, and then bought a $30 put, and they would have the same expiration. So I've also varied the expiration date, right? And so if I wanted to, I could call this a diagonal calendar butterfly put, and get all stuck up, all hung up on that option terminology. But just understand what I'm doing. Now, I believe that Uber is going to do a pullback, but I do not believe it's going to go any lower than this level right there. I think that is a very fair level of price that I think Uber is going to go back down. Okay, now I don't know for sure, so that's why I sold a bunch of puts to try to bring in extra premium. Okay, because if I just did the long put spread, I'm taking in that debit, but if Uber just keeps going up and it doesn't pull back, then I would just lose money on the put spread. So that's the reason why I sold to open more put spreads to bring in more premium. And that's one of the main ideas of an option butterfly is like if you're bearish, okay, you might think, okay, I think Uber's going to do a pullback, so I'm going to buy a 40 put and I'm going to sell a 35 put and I'm going to take in that debit, and either Uber's going to go up or down, and ideally you would want Uber to go down, right? But if it doesn't, then you would lose money. And if Uber doesn't go down below 40, if I were to spend $430 and sell to open at $240, then I would take $190 loss, right? So that's where the butterfly comes out. When I do a butterfly, I'm basically saying I want to take in more premium just in case Uber doesn't pull back, and it'll lessen my risk on the upside. So what I would do is I would buy the 40 put, sell the 35 put, and then sell another 35 put and buy a 30 put. That brings in extra premium, which lowers my cost basis of the put. So let's say we did that and we get this filled at 240, and let's say we buy this at 140. That would bring in an extra $100. And so now that lowers the cost of my put option down to what? $90. And so now I'm risking $90 under the belief that Uber would go down. And if Uber went $90 lower than $40, that's my break even. It would be $39.10. And then if it went down to 35, that would be my max profit. So I could make up to $410. Now, if it went down more, then now my profit starts getting cut into because I have a credit put spread, right? I sold a 35, bought the 30, right? And so if it went to 34, I would take $100 loss on that profit. So now instead of making 410, that would be 310, 33 would be 210, 32 would be 110, $31 would be 10, and if it went all the way to 30, then I would lose $90. So notice how I'm taking the same risk on both the upper end and the lower end. If I do this long option butterfly on the puts, I'm spending $90. But if it goes down to $39.10, that's my break even. And notice how it's the same on the other end. If Uber went all the way to 30, I would take the same $90 loss. So I lose $90 if it goes below 30. I lose $90 if it goes above 40. So my profit area, my area of profit, I would want it to trade somewhere between $39.10 and $30.90. Those are my break even. So my window of profit would be $30.90 and $39.10. And if it traded in the middle somewhere, that'd be my max profit, which would be $400. And that's a pretty good, I mean, when it comes to the money, you know, I could lose $90, but I could make $410. So the math works out pretty good. Now the question is, how does the chart work out? What is Uber going to do? So if Uber indeed keeps going up, then I would take that $90 loss. And since I do think Uber is going to pull back, but I do not believe that Uber is going to go below that $35 level, it might go a little below, then for me, I have a little stop loss. It's a mental stop. If I see Uber go below $35, then I'll get out of the trade and I'll take a loss because I did 8 put spreads. I didn't do just one, I did 8. You can see right there, 8 and 8. Right? So I convoluted it up, but as long as you understand the basic idea of an option butterfly, which is you're buying a put, you're selling a put, and then you're selling another put and you're buying a lower put, it brings in more premium to pay for the cost that you're spending on the put. And you can also do the same thing with calls. If you think that Uber's going to keep going up more and more, then you can do the same thing with calls. But you can see I did 8 and 8, right? So this is not a straight up option butterfly that I'm doing. This is me basically making the belief, and also I calendared it. See, these 8 puts expire in December. That's in about 5 weeks from now. These are 6 monthers, okay? This one doesn't expire till June, and this one doesn't expire till June. So for me, for my position, the best thing that can happen to me, if Uber trades above $35 and these puts expire worthless, then let's go back to my transactions. Then I will get to keep all of this premium, okay? 5, 6, and 8. So that's 150, 180, 240. Now I spent $427 minus 239. So I spent 190. So I would lose, let's say in 6 months, you know, let's say I lose all the money, I would lose 190, but I would make 240. So if Uber trades above $35 a share, and I wouldn't be doing this if I didn't think it was going to do that, and my hope is that it will, then I keep this $240, I spend $190, and then I have a risk-free trade, and I can hold this put spread for another 5 months, or I can get out and just keep the little bit of profit that I'll have. There's all sorts of things that I could do. I can even start to compound and start put on more spreads. And then I would have 2 put spreads, and then 3 put spreads, and then 4 put spreads or butterflies or whatever what I want to do. So that's the basic idea of an option butterfly. It's a really good strategy. I don't believe there is such thing like this is the best strategy, this is the worst strategy. The market conditions and your bias or your belief on the stocks that you're trading tell you what strategy you would do. You should never wake up and say, I like the cover call strategy, I like the iron condor. You don't do that. You look at the markets every day and then you decide for yourself based on what you think the particular stock is going to do. And I'll close this video by saying that elections are a pretty good time to make some money. A lot goes on. And in the case of Uber, Prop 22 passing was a big one. And so I think Uber is a good option trade right now. So I would say, and I'm not a pro, I'm not a financial advisor. I will just say, as a very average person, take a look at Uber and see what you can come up with. So that's it for this video. Thank you for watching. As always, if you have any questions, you can hit the like button, whatever you want to do. Show some love and support. And thank you. I will see you in the next video. Have a good day and ciao.